Let's talk about something that does not get enough attention, the capital stack. Because one decision in the capital stack can quietly change your entire investment outcome. Now, at a high level, the capital stack is simply how a deal is financed. You typically start with the senior lender, senior debt at the bottom. Um, you may have preferred equity or mezz debt in the middle, and then common equity, where most passive investors sit. Each layer has a different risk and return profile, and each layer gets paid in a specific order. And that order matters because if the deal underperforms, the impact flows upward, meaning senior debt gets paid first, then preferred equity or mezz debt, and whatever is left goes to the common equity holders, which essentially means that as a passive investor, you're often the last in line. Now, here is where things get a little bit more nuanced. In today's environment, we are seeing more deals include preferred equity and in some cases mezz debt. On the surface, that can sound positive because it helps get the deal done. It may reduce the amount of common equity needed to raise upfront, but it also introduces another layer that needs to be paid before the common equity stockholders. Preferred equity often comes with a fixed return, monthly or quarterly payments, so before common equity sees distributions, those payments need to be made again first to the lender, then to the pref equity holder. And if cash flow is tight, that can reduce or eliminate distributions altogether, even if the property is performing reasonably well. Now, add a higher leverage to the equation, in other words, more debt, which translates to more fixed obligations. Suddenly, the margin for error becomes very thin. What looks like a well structured deal may actually carry more risk than it appears, especially if performance falters. Now, this does not mean preferred equity or leverage are bad. Not at all. They're just different tools. But like any tool, they need to be used and evaluated carefully. Here is how I think about it. Look beyond the projected returns, understand the structure, and ask how much total leverage is in the deal? What are the total fixed payment obligations, and where do I sit in the capital stack? What happens if cash flow softens? Because the capital stack determines who gets paid in what order and who absorbs the risk. If you do not understand that upfront, you may be surprised later. Before you invest in your next deal, take a step back and do not just ask what are the projected returns. Instead, inquire how are those returns structured? Because protecting your capital starts with understanding where you stand in the capital stack.